Thanks again for being with us. Time now for our top story. The price of gold is rising this morning as new U.S. economic data out this morning has made investors a bit more confident in a September rate cut from the U.S. Federal Reserve Board. For the record, gold's highest price ever was released on July the 17th this year when the December contract, which we're looking at now, touched $2,537.70 U.S. per share, U.S. per ounce. Our next guest has lots of insights to share. He, as we mentioned earlier, is Brooke Thackray, research analyst at Global X. That's the company formerly known as Horizons ETF Canada. Brooke, thanks a lot for joining us. You've got some insight on gold and its relationship to bond yields, particularly the U.S. two-year, and that, of course, serves as a near-term predictor of U.S. inflation.
Yeah, I mean, gold's done extremely well this year. It's, as you said, just reached all-time highs recently. And it's got many different drivers, but one of the drivers is the two-year yield on the U.S. dollar. And when you find the two-year yield dropping, and the two-year yield is the most influenced part of that bond curve by the Federal Reserve. So if the Fed starts cutting rates, that means the two-year yield is going to start to head down. Mm-hmm. And if you take a look at the two-year bond yield here, and you go back, when it starts to drop down, as it has been recently, you find that gold will actually increase. Okay,
so here's the graph that you prepared for us. There's a lot here, so we're going to take our time to explain this to viewers so they've got it correct. The white line is the price of gold, and you measure that white line against the left axis, the axis that goes from 300 near the bottom to near 3,000 at the top. The blue line is the U.S. two-year bond yield, and you can see it, and you measure it against the right axis, which is measured in percentage points, and you see it rising from 1 to 8 over that the upward trajectory of that right axis. The yellow shaded bars are periods where the U.S. two-year has plunged, and you'll pick it up from here, Brooke. But during those periods of declining U.S. two-year bond yields, the blue line has come down, the white line, the gold price, has risen. Why don't you pick it up?
Yeah, so if we go back to 2000, what we saw the two-year yield decrease after the tech wreck, it came down. And as it was coming down, gold did extremely well. And it's not just for a little bit. And this is why this is important. It's actually a multi-year phenomenon. So despite gold reaching a high right now, it can keep going. And if we go back to 2007, we see the exact same phenomenon in the great financial crisis. We saw the yields start to come down, and then gold did extremely well once again as it was coming down. That was a multi-year phenomena. We saw that back in 2018 when Powell pivoted. So 2018, December 2018, Powell pivoted at that time. Two-year yields started to come down, and gold performed extremely well from there. And we're in the same type of situation right now, where Powell has largely indicated that he's going to cut the rates in September. He hasn't come right out and said that, but financial markets are expecting that. So we're at that point now where we're going to probably see some downward pressure on the two-year yield over the next while, and that should give gold a bit of a boost. I think the big story here is that it can be a sustained boost. Like if we look back at those periods that we had highlighted in gold there, they were a multi-year period. So despite gold doing well right now, gold can do well for the next couple of years from here. So I think it's actually a good point, despite reaching an all-time high.
What has happened to the narrative that gold likes a high inflationary environment because gold is a hedge against inflation? We often hear that when inflation is rising, at least from the gold bug community.
Yeah, so it's more important, actually. We say that with inflation, that's true, but gold is more driven by real interest rates. And as the inflation rates have come down, the real yield has increased, which should hurt gold, right? But it hasn't, because investors are playing on the expectation that the yields will come down, which will lower that real yield down. So it's more real yields that have the impact. And it looks like real yields will start to come down as the Federal Reserve cuts rates.
And what is the reason that gold tends to benefit when real yields go down? Is it because interest-bearing securities tend to yield less, and gold as a non-interest paying security looks better in that context?
Absolutely. It's an opportunity cost. So as real yields come down, gold becomes more attractive relative to interest-bearing securities.
Okay, let's again take a look at the current price of gold. And after we do that, we'll just remind you what the record numbers are as we continue to watch gold. There's gold trading now at $2,492 per ounce. And here's a board that shows you a couple of the historic benchmarks to keep in mind. What we're looking at now is the December contract. The high on the December contract was reached in July, and it was $2,537.70. So we're about $47 away from that or so. In the spot market, which is a different market, and you see a very different price, a lower price. Tends to be a premium ascribed to future delivered gold. The spot market all-time high, $2,483 per ounce.